Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the Monday, the 27th of March, Bull versus Bear webinar here. Steve Miley on the call for Trade Day. Welcome, everyone. Right. Actually, I'm going to jump back to our the website. I mean, I've been banging on about this for the last few days, but you know what? We put a lot of work into this, and we're only going to get a few days to publicize it before it's old news, so might as well do it one more time. We've launched our new site. Look at these two handsome fellows on the front. That's me on the right. This one here. So take a look at the new site. There is a new pricing page, is what most of you are going to be interested of, about the changes to the programs. We have different tiers. We have smaller tiers. We have bigger tiers. Different rules. No more stop loss rule. Rather than me going through all this is not a sales pitch. Come down to the bottom in here, right? Come down to the bottom of any of the pages. Okay. We have this trading advice and tips. Okay. It's not actually at the top in here, but we don't have it. Trading advice and tips. Okay. And you can see the first one in here, this blog area, is Trade Day Evolves. It's kind of a little blog mini press release in here. I'm gonna throw that into the chat. So hello. Is that, it says Timilly, but I'm assuming is that Tim or Tim? I don't know. But anyway, there you go. Take a look at that, guys. That tells you everything you need to know about the changes that we've added in, the new rules, the new regulations, the new policy, the new pricing, blah, 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 blah. I'm not going to make this into a sales pitch. Right, let's get on with what's going on in markets. I'm going to go through this. Remember, this is in the traders area. I put this up every weekend, usually goes up Saturday or Sunday in here. So please do go check it out. It's a good resource, I think. Anyway, I've written it, so I would feel that way. But this is like a recap of last week, what we've got coming up this week, what impacted markets and why. I'll go through this very quickly in here because I was covering it on all the webinars. But basically, so not this weekend, just gone the previous weekend, UBS bought Credit Suisse for 3 billion, just over 3 billion Swiss francs, actually, just over $3 billion. Last Monday, we had markets a bit in panic mode because the Swiss National Bank, in brokering this kind of deal, decided that they would write off $17 billion worth of Credit Suisse's AT1 bonds. COCOs, they're called, conditional convertibles, additional tier 1 bonds, AT1 debt. In here, the market did not appreciate this. It sent banking bonds, banking stocks go lower in Asia and European. We did bounce them last Monday, though. Then we had the Fed raising rates by a quarter. So they'd obviously parried back. That's what the market was expecting. Dot plot chart, though, indicates that Fed officials expect one more hike in May and then stop. Okay. But Jerome Powell made it very clear Fed officials don't see any rate cuts this year. They just don't. Quote, that's a quote from Jerome Powell, only back on a few days ago, last Tuesday. And then we get CME Fed Watch tool, though, and we'll come and take a look at that shortly. At the end of last week, it was showing a rate cut for every meeting for the last 4 meetings of this year. Okay, so 25 up and then 4 25s down at least. It was pricing in, not quite pricing in as a dovish as that right now. We'll take a look at that this morning, or now, this lunchtime for me, actually. So we will take a look at that. Bank of England raised interest rates, the 11th consecutive interest rate hike in here to 4.25% last week. Remember, UK inflation running hot, much higher than expected last week at 10.4% in February. S&P flash PMI for the Eurozone actually hit a 10-month high back on Friday. 54.1. Consensus was at 51.9. So that was certainly good for Europe. But Friday morning, there was no webinar on Friday. We didn't pick this up on Friday. But Friday morning, European markets were in a tailspin in here. Deutsche Bank shares and debt plunged lower. because there was a run on their, well, not a run, but there was a spike higher in a widening of their credit default swaps. This is kind of the credit default swaps, a part of what caused a lot of the issues that we had back in the last financial crisis, 2007, 8, 9. Okay, we had a widening in the credit default swaps on Commerz and on Deutsche Bank, also Commerz Bank, other German banks, other European banks, the broader banking sector globally as well. Saw the credit market for banking debt see significant moves to higher yields. Got into real troubles. And then we also saw the European banking sector stocks go significantly lower. They did rebound, okay, but the whole sector was looking very negative, and there was a big risk-off move that we saw, certainly through the European hours. Despite all of this, okay, US stock averages were up last week. European stock averages were actually even were higher, despite the losses on the banking sector that we saw on Friday. But US and European bond markets surged higher. Safe haven, buy bonds. Bonds went higher in price. That's lower in yield. The US and German 10-year yields hit multi-month yield lows last Friday. Forex markets, which have been relatively quiet, saw an increase in volatility. The US dollar was initially weaker, and then it rebounded as a safe haven at the very end of the week. And the star performer last week was the Japanese yen, as we went into risk-off mode as the safe haven currency. Gold almost went higher. 2023, a multi-month high, up at $2,000 in here, the ultimate safe haven. And oil was very negative in here. Why was oil negative? Because there's an anticipation of slower global demand and a slowdown in the global economy because of the credit crisis, okay, or this little mini credit crisis, financial crisis that we're in right now. A reminder, if you're in Europe, UK in here, we've shifted or you would know that we've shifted daylight saving time in the UK and the EU on Sunday. So we're back to the usual time difference. The last 4 weeks in here, so for example, between UK and New York, London and New York, throughout the year, it's usually a 5-hour spread, okay? For the last 2 weeks, there's only been a 4-hour difference. Okay, so now we're down. We're down to only a 5-hour, back to a 5-hour. Okay. Central bank watch coming up. What do we have coming up in here? Not much, and not much on the Fed speakers. I'm going to talk about that shortly. But remember, this last week we've had the Swiss National Bank, we've had the Fed, we've had the Bank of England. The week before we had the ECB. We've got nothing this week from any of the central banks on any of the fronts of minutes released. There's no major central bank meetings. There's no minutes being released. Even on the Fed speakers, they're out of the blackout period. But I'll go through the Fed speakers calendar that I'll share with you shortly. That's actually from the Fed site. There's very little this week. Okay, so we're dying for some Fed speakers. We've had blackout for like 2 weeks. Okay, we're in this huge event, but of a mini crisis in here, and we've got no Fed speakers coming up. Even though they're scheduled to speak about other things, usually they will talk about what's going on. They'll be asked questions, but we've got very little coming up this week, so that's a bit of a disappointment, really. Data, the first part of the week, super uber quiet in here. We pick up in the last part of the week. You'll see in here, look. So we've had German IFO this morning. Okay, we'll talk about that in a second. But we've got Australian data coming out Tuesday, Wednesday. Hardly anything out of the UK, out of Europe, out of the US. And then Wednesday, it picks up a little bit. EU consumer confidence, German CPI, that will be important. And then we get US GDP and PCE data on Thursday. Remember the PCE, personal consumption expenditure. That's the data the Fed tell us is their gauge of inflation. That's what the Fed try to look at, okay? We also get then some more data out of Europe and Asia in here. As you can see, we get Japanese CPI, Chinese PMI, UK GDP, German retail sales and unemployment, and EU CPI. That's all important data out of Asia and Europe on Friday. And then we get the further US PCE. Remember, they split that PCE. I don't quite know why, actually, but we get the PCE. We get some of the month-on-month data, the quarter-on-quarter, and the year data. Some of it comes out with the US GDP on the Thursday, and then the other parts of the data come out on the Friday. Then we get Michigan consumer sentiment. So we don't really get anything of note until the very last part of the week. And from the so Thursday, Friday is really going to be the focus. But between now and then, obviously, we've got a potential for more banking issues. Okay, at the moment, thankfully, having had 2 weekends of kind of carnage on the banking side. We've had the failures in the US. SVB, and we'll talk about that. Silicon Valley banks shortly as well. Then we had Credit Suisse, UBS, spoke about that already last weekend. This weekend, sigh of relief, nothing. And the market will take that as kind of risk on, as bullish, right, for stock indices. Why would it take it as risk on? The more we move away, the more we have no events, the more we have, the market's worried about is the fear is contagion spread, right? That's what happened in the last financial crisis. That's what happened in all financial crises. You get it. Markets are all interrelated and it spreads. The further we move away from events, the more time we have. Time is a great healer in markets as well as in the rest of life, right? So when we have these events, the longer we go, the further we move away from the events without having further events, then that's seen as a positive by the markets. And this weekend was as a little bit of a bit more of a relaxing, in that we didn't get too much. So I'm not sure if is that Tim. It says Tim Lil. I'm not sure if that's Tim or Tim Lil. But how do you trade Dow Jones? Well, yeah, thank you very much, Greg, in here. There's the codes in here, but it's like 200 points off from TradingView, but that's okay, right? No, that should not be the case. But remember, this is the future. Okay, remember, this is the future. You're trading. Please, can you post these? Any questions you have on this kind of front in here, Tim Lil? Please do pop them into a ticket to us. But yeah, remember, this is the future. This is not maybe what you're seeing on TradingView. Maybe what you're seeing on TradingView is something different. Okay, so those are the codes though for the E-mini and the micro, the mini and the micro Dow Jones symbols that Greg's giving you. Those are correct. Okay. If you're seeing something different on TradingView, you might be looking at the cash index. Remember, these are the futures markets, not the cash market. Okay, so it might be something different. You might be looking at a CFD. You might be looking at the cash index. I don't know what you're looking at on TradingView, but if it's 200 points off, it's not the same market, right? It's not what we're trading, what you're trading here on the futures side. Okay, so that's what we got going on. This is what I said about it. I'll share this with you guys in the chat actually. So in here, boom, there's the Fed calendar, okay? So if we go down here for where we are this week from the 27th, in here you'll see we have Jefferson speaking today, and he is on if I go and look at the calendar, it's actually not on here, but he is speaking later this evening. We got Jefferson speaking later this evening. Where are we in here? Phil Jefferson. 5 p.m. These are Eastern time. Okay, 5 p.m. But then we get so Vice Chair for Supervision Michael Barr speaking on Tuesday, Wednesday in here, but before the U.S. Senate Committee on Banking. Okay, is that going? Housing and Urban Affairs, bank oversight might be interesting. There might be Q&A that helps us out there. We get that on Tuesday and Wednesday. Okay, so maybe watching out for that. Then we get nothing Thursday. And then Friday, the speakers we do have are very late in the day, right? Post US close in here, even. So we get Cook and then Waller speaking, but very late in the day. So whether they actually influence markets is going to be another matter in here. So, so nothing really from the Fed, which is like really quite kind of, no Fed speakers. We're looking for Fed speakers to give us some guidance, because, the markets are still in a little bit of turmoil. German IFO this morning, by the way. So the German IFO is kind of like, so this business expectations, it's kind of like, it's for business in Germany, okay? It always was, particularly pre-Euro, it was always a very much watched piece of data, the German IFO Business Climate Index in here, better than expected. So that's a real positive, considering all the, excuse my language, all the crap that we got going on, all the stuff that's going on in markets with respect to the banking issues we're having in here. This is a real positive that this was higher than expected. Okay, so this is similar to the PMI data, the Purchasing Managers Index data. Okay, and so that was better than expected today. So that's certainly a positive. Let's look at 5 things to start your day. If you don't usually come on the webinar, you should sign up for this. If you go to bloombergmarkets.com, let me show you where it is in here for anyone who's, If I go to Bloomberg Markets, you go to bloomberg.com/markets. If you go here, Okay, if you're listening in on the recording, over on the right-hand side, the most important market news of the day in here. Stick your email in here. You'll get at the beginning of your day, wherever the beginning of your day is, you'll get an email telling you what's been happening, 5 things to start your day. It's a real useful resource because a lot of these articles in here, 5 things is free, okay? But most of the articles on Bloomberg you have to pay for. I'm going to run through some stuff for you. I've got a membership in here so I can show you some stuff. But if you want to sign up, Bloomberg's not particularly cheap. Okay, so Credit Suisse in here resigned. Not Credit Suisse, the Saudi National Bank chairman resigned after he put Credit Suisse shares into a tailspin that created the problems that ended up to them being taken over. U.S. authorities considering expanding their emergency lending facility for banks. Okay, so we're seeing that in here at the moment. So that's seen as a positive. U.S. more support for banks while giving First Republic time. So that's certainly a positive. Okay, more support from banks. Kashkari's been on that now. Remember Kashkari. Okay, Kashkari is very much in here. Where are we? Fed's Kashkari. Here's the article. It says bank strains bring risk of recession closer. Okay, it says too soon to make any judgment. Okay, this was from Sunday night. Okay, he was on CBS, Face the Nation. Okay, and in here, what's unclear for us is how much of these banking stresses are leading to a widespread credit crunch. Would that slow down the economy? This is something that we're monitoring very, very closely. Okay, now remember, let's go look at our FedWatch tool. Where are we in here? I can show you. So this is the one I tend to like because it's on the site, one of my sites. Okay, so FX explained in here. If I go in here and show you this not study FedWatch tool, Hawk Dove sheet. Excuse me, I'll get it right. Hawk Dove sheet. Hawk Dove sheet. Oh, Hawk too many times. 1 second in here. Hawk Dove sheet. Let me show you this. Hawk Dove sheet. Here it is. I'll share this in the chat. This is a useful resource, guys. I would suggest bookmarking this one. If you don't know who your hawks are, who your doves are, not just in the Fed, but also in the Bank of England and the ECB. Look, here they are. Bank of England, Hawk Dove sheet, ECB, Hawk Dove sheet. But here's for the Fed. Where's Kashkari? Doves at the top, hawks at the bottom, Kashkari down here. He's a hawk, right? He's a hawk. He's a voter as well, right? So Neil Kashkari is generally a hawk. And let's go and see in here, right? So these remarks are definitely slightly shifting dovish. They're not particularly hawkish. Look, his remarks were more guarded than a trio of Fed officials speaking Friday who said inflation remained the top priority and warrant further policy tightening. So that was from back on Friday. That could reflect a shift by the Minneapolis Fed chief. The Minneapolis Fed chief is Neil Kashkari, who in recent months has been an outspoken hawk favouring rate hikes to cool prices. Now, Kashkari was pre the inflationary scenario we've been in, he was always more of a dove, okay? During the inflationary phase and the fact since we've been hiking rates over the past year, Kashkari has certainly shifted to one of the more hawkish within the FOMC. However, these comments in here, the fact that he's now concerned about recession, okay, concerned about the crisis, monitoring the crisis, this says to us, right, he's stepped to slightly more dovish away from hawkish. That's then seen as then indicating potentially the whole committee is potentially shifting slightly more dovish. And if that is the case, then maybe what Jerome Powell said to us last week about no rate cuts this year, maybe that is going to shift, okay? And that's certainly being reflected on what we're seeing in the on the Fed tool in here. Right, I'm going to move forward here. So US Moles more support. We've already spoken about that. US futures are up. Why are futures up in here this morning? Well, US Moles extra support. That's one thing in here. Kashkari a little bit more dovish. That's another thing. Deutsche Bank bounces this morning, okay, in Europe. Okay, we also had that German IFO numbers, okay. German lenders shares rally after Friday's steep sell-off. Kepler says Deutsche Bank not weak link in European banking landscape. So we've had a vote of confidence in here, and we've seen a rebound in Deutsche Bank shares having been hit really significantly, 5.54% higher, having been hit significantly back on Friday. So rebounding after Friday's sell-off, not just the shares, also the CDS has corrected. Also, that's the credit default swaps. So that's all a positive as well. And also the other piece of news over the weekend, having had 2 pieces of really negative news the last 2 weekends with banking issues. First Citizen buys Silicon Valley Bank, SVP. Okay. So again, seen as a positive. Someone stepping in and mopping up Silicon Valley Bank in here. That's so the lender assumes $56 billion in deposits, $72 billion in loans. So that's a positive, okay? FDIC says estimated cost of SB failure is $20 billion. But nevertheless, the fact that another bank is stepping in to take over Silicon Valley Bank is seen as a positive. So all these things are pointing stock indices higher. First Citizens agreed to acquire failed Silicon Valley Bank in here. What else do we have? Banking. But nevertheless, this is still on the back burner, guys. Don't think this has gone away yet. Banking stress puts US and Europe on watch for credit crunch in here, and banking crisis raises concerns about hidden leverage in the system. Don't forget, this has not gone away. We've got an easing of the pressures in here at the moment, but it's far from gone away. But nevertheless, if we see here, the futures are not, but futures are pointing up in here this morning, nevertheless in here. And then I just want to share with you, let's go through the Fed tool just very quickly. So the market's certainly now pricing in one more rate hike. The Fed have told us that. That looks like it's nailed on in here. A possibility of one more rate hike. That's over here. But look, the market is mostly looking for no rate hike now. 65% no rate hike, even though the Fed have basically told us they are going to hike rates in here. But we go to the meeting after that, still 475,500. So the market now doesn't believe the Fed, doesn't believe we're going to get another hike in here, 475,500. That's where we are right now. Current target rate, 475,500. Yes, there is a chance that we get a quarter, but the market more believes there'll be no more hikes. But then we go to July, cut 25. September, probably staying the same, maybe a cut. November, cut another 25. December, cut another 25. The market is projecting that we're 75 basis points down, 400, 425 by December of this year. 75 down from where we are now, and potentially not even raising rates. If we do raise rates, it'll be 25 up and 100 down, or more likely the market is pricing in no more rate hikes, 75 down through the last 4 meetings of the year. That's kind of very, very, very much not what that Powell told us. Remember, we said in here, where's the stuff from Powell in here that, I'm not sure where it is. In here, it was in the in here, right? I quoted him from last week. He said, Fed officials don't see rate cuts this year. They just don't. Okay, that's what he said. But the market is pricing in something very, very different. So just Tim in here, just to see, this is what you're looking for. If you're looking for the Dow Jones, okay, in here. Here we go. These are the contracts. The micro, okay, MYMM3, okay, as was put in by Greg. Thank you, Greg. And the mini in here, YMM3. Okay, those are the 2 codes that you need. Okay, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Any more questions? Any questions? Thanks for that, Greg, by the way. And I say it says Tim Lil. I'm not sure it's Tim Lil or Tim Lil. But hopefully that answers your questions. Any further questions, please do send them in to support@tradeday.com. Support@tradeday.com. Any questions from anyone on what we're seeing? I haven't gone through the charts today, I know. But yeah, the market's looking fairly positive on going into the open on the stock indices side anyway. Here we go. Push it back higher. That big sell-off and rebound, big bullish candlestick from Friday, pushing high this morning. There's the S&P, and here's the NASDAQ in here. Inside pattern, still inside, but very resilient. Remember, last week we made a new high for the year at one point last week. All right, guys, going to wrap it up there. Have a great trading day. Take care. Stay safe. I'll be back with you with another Bull versus Bear webinar, same time tomorrow. Bye.